Dear friends, the festival season is upon us. So let me begin by wishing all of you a very happy Diwali and a very happy New Year to you and your entire family. I hope the new year brings a lot of good health, happiness and prosperity. This month, we will talk about three things. We'll talk a little bit about the economy and what's happening. We will talk about earnings, and then we will talk about the markets. As you all know, except for very small pockets and incidents of COVID-19, I think pretty much the pandemic is now receding and slowly normalcy is coming back. We now see malls are full, holiday destinations full, schools, cinemas, gatherings, everything is coming back, and that is good news for us and for the economy at large. We are seeing rapid demand recovery across sectors, though current data does show that the recovery is more tilted currently towards the high income groups, and we can see that in the kind of housing sales. We can see that in terms of the waiting list for cars and various premium discretionary items. But I do believe that as this recovery holds further ground, we will start to see a broad-based recovery moving to even the smaller towns and villages and the rural areas of India. And we can see that we are beginning to see the benefits of a more formalized economy, more consolidation across sectors, and the latest data that came was very heartening that GST revenues have started to come back, with the latest figure being at almost 1.3 lakh crores. The peak that we had reached was 1.4, and I'm very confident that in the next few months we will cross the peak of 1.4 lakh crores as well. So the good news is that the economy is doing very well. And one of the most important and seminal reforms actually got executed recently, which is the privatization of Air India. And believe you me, friends, it is nothing to scoff about. I think it is one of the important milestones in India's reform process, and we can expect many more public sector units which will get divested or privatized over the next few months. And I believe that can usher in tremendous productivity gains for the economy. Coming to earnings, and we are currently going through the second quarter earnings, and if I were to kind of describe this earnings season, I would say that it's satisfactory, reasonably good. There are still companies and sectors which are managing to either show earnings which are in line or even above consensus. Of specific reference is the financial sector. As you all know, that the financial sector went through a tremendous tough period throughout COVID, and there were large provisions which the banks and the NBFCs had to make. But the quarter two results give us a lot of heart and comfort that the worst now seems to be over. And I think going forward, unless there is a significant third wave, for which I think the probability is very, very low. I think that finally the banking sector and the financial services sector is off to a great recovery path. However, there are a few areas which are concerning in the second quarter results, and that we have seen that there is a significant inflation in raw material prices, and that has put pressure on the EBITDA margins of several companies, especially consumer companies, automotive, chemicals, even pharmaceuticals. And I think the supply chain disruptions which continue in China and around the world still continue to hobble companies, and we believe that this could lead to tempering of margins and profit expectations over the next couple of quarters. Now, is that something that should worry us? Well, not in the long run, but I think in the short to medium term, it will pose some challenges. But I'm very confident that the Indian entrepreneurs and companies are very, very adept at managing these kind of challenges. And I hope, and I'm also reasonably confident that these challenges are more transitory than we would think them to be. I think coming to markets, and as a result of the softness that we are seeing in the margin front, we have seen that many stocks have corrected meaningfully by about 15 to 20% or even more during the second quarter results in response to the impact on margins. And I think that this correction and pause is necessary, and it tells you that fundamentals still do work, and it's not just about liquidity, as we've been saying for a long period of time. And therefore, I do believe that we could be entering a phase in the markets where the markets could pause and consolidate in a range, which I think is healthy. I think a lot of investors were waiting that the markets would correct so that they could step in and invest. And I think that every correction should be used as an opportunity to invest. However, our conviction in the long-term structural earnings growth story of India remains as solid as ever. And as you know, last month and the previous videos, I have shown data to show that we are indeed entering a structural bull market in earnings in India. And I think that that is not in question despite the near-term challenges that we are seeing because of the rise in raw material prices. I think that the current corporate profits to GDP, which is at about 2.6% in March 21, I won't be surprised if we double that over the next 3 years to 5%. And that would mean a 30% compounding in earnings for corporate India. And earnings growth is one of the central pieces why we believe that we have entered a very long structural bull market in India. One of the things that we have seen, and a lot of you have asked us about the new age IPOs and companies, and whether you believe that we would be taking advantage or investing in some of these businesses. Well, I think the IPO boom in India is very, very healthy for the stock markets. Every time in the past, whenever we've seen that IPOs have been very successful, it draws in completely new set of investors who first come by applying in an IPO and then stay back in the secondary market as many of these companies get listed. It is also reflective of the new dynamism of entrepreneurship that we are seeing in our country. There are many new cutting edge entrepreneurs, business models which are debuting in the IPO. Yes, the valuations of some of these companies can be debated, and therefore we will participate by investing in these companies very carefully. But we are looking at that entire space with a lot of interest. We are doing our work, and we believe that over the next 12 to 24 months, the markets will give us an opportunity to participate in many of these new companies that are getting listed, and many of these can be challengers to traditional businesses. Having said that, I think the best way for you to participate in the new IPOs is to invest in our AIF, which is the Alchemy Leaders of Tomorrow. Some of you who have invested with us, but for those who haven't, I would urge you to take a serious look at that strategy, because in Alchemy Leaders of Tomorrow, we do plan to either participate in the IPOs or invest in many of these new digitally savvy cutting edge companies in that particular fund. So do reach out to your relationship managers and take a serious look at the opportunity in Alchemy Leaders of Tomorrow. Having said that, I am also enthused about one recent event which happened in the stock market, and that was what happened to IRCTC. Now, why is this important, right? While we are not invested in IRCTC, but I think that when there was this event which happened where the government decided that there should be a 50-50 sharing, which came just out of the blue ad hoc, it created massive volatility in the stock price. And that tells us that how we need to keep certain risks in mind when valuations go parabolic. And obviously it was not well thought through, and it was quite abrupt. It would have really derated the entire public sector universe, and that's one reason why many managers do not invest in public sector units. However, I'm very enthused by the fact that the response time of the government was very quick. I think they realized that what they did was wrong, and that it would be an affront on minority shareholders if you bring this kind of policy changes which are quite abrupt. But the fact that the government realized and retracted from there gives me a lot of confidence that this government is very serious about creating value in public sector units, about privatization. And while we also have a belief that as far as possible we should stay away from investing in public sector units, but this particular reaction gives me some hope that selectively we should probably look at seriously evaluating some high quality PSUs for investing. Again, I can assure you that we will be very calibrated and very thoughtful in our approach. But I think that if the largest shareholder in this company understand the value of market cap, if they understand that minority shareholders should be respected, then I think that there is a lot of money to be made. So going forward, over the next few weeks and months, we will take a very serious look, very selectively, at some opportunities there. And if we believe that no, there is a reason why we should be investing in these companies, we could look that within our investable universe. But as I said, it is quite heartening that all the recent policy announcements by the government, whether it is privatization, whether it is divestment, and as you all know that despite the continuous rise in oil prices, the government hasn't forced the oil marketing companies from increasing prices. And again, that is something that we need to think about, which means that they are allowing free market to really play out. And that's a very, very critical input to unlock value in many of these companies. So with this, I'll make it short this month. I wish you and your family members again a very, very happy Diwali and a prosperous new year. And we will get back in touch with you next month. Thank you.